Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in this week and every week to hear what we have to say about mortgages, about the economy, about what's going on, to help you make some decisions, whether you're going to buy a house, whether you're going to sell a house, whether you're looking to rent. You certainly need information about, really, I think, is still the best value, even though house prices have gone up quite a bit this year. Buying a home right now is still a great thing. Now, I heard some interesting, first of all, a little bit of housekeeping. If you want to see the show each and every week, you can go to YouTube. YouTube is Jeff Barton, the Mortgage Voice. You can see it. If you want to hear the show, we're on 5 radio stations, 3 different states. Albuquerque down at WIN. I just talked to them today, trying to get some local people from Albuquerque on the show, as well as up into the Lake Tahoe area, a couple in the Inland Empire in Southern California, as well as Las Vegas, Nevada. You can hear all these shows. Some of the shows carry video feeds, but to see the show, go to YouTube. We're also on 8 major podcasts, the Big 8, they call them, and I think, Daryl, you have a list of those Big 8 for us, please?
I sure do. It's Apple Podcast, Google Music Play, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, and of course, as you mentioned earlier, YouTube.
Okay, excellent. And that being out of the way, what is happening in the economy? What is happening for mortgage rates? What is happening all over since COVID has taken over is that the economic news is really wrapped around what's going on with COVID relief and how people get back to work. And hidden in all of that is the fact that the real estate market and the mortgage market have really, as my employees like to say, has been on fire. The actual business that we're doing is more this year than we've ever done. And that is saying something. We've been in business at my company for 20 years, Malibu Funding. They're the ones that host the show and sponsor the show. So if we're saying that real estate is still an excellent buy, even though the prices has gone up, one of the reasons for it is the fact that, you've got stupendous rates. Let's just get right to it. Rates today, 30-year fixed, 2.8%. 15-year fixed, 2.38. The FHA loan is at 2.35%. 3.17 for jumbo, and a 5-1 ARM at 2.52. Now, all of those particular rates are the best rates available for the best clients. Now, what do I mean by that? Credit has something to do with it. Ability to repay has something to do with it. Tax returns have something to do with it. If you present yourself as a W-2 employee that has an excellent chance of retaining that job for many years to come, as well as 750 plus FICO score and provable income assets, you're going to get those particular rates. If you've got some blemishes, the rates are going to increase a little bit. If you are a person who is a self-employed borrower, if you are a bank statement borrower, if you are a non-QM, which is used to be called subprime, those particular rates are not available. Obviously, all those rates I quoted are loans usually sold to Fannie Mae and Freddie Mac and Ginnie Mae. Those are FHA and the GSEs buy up loans from everybody. So let's talk now about the U.S. economy. The U.S. economy, as everyone knows, is reeling a little bit, but other than the real estate sector, the online sales sector, the grocery store sector, anything bought and sold on Amazon, there are a number of competitors for Amazon also doing very well. Zoom is doing terrific. How we're shooting this particular show, I saw yesterday where Zoom is up 348% for their stock price. Now, that's interesting, right? Now, what does this mean for you as a borrower? If you're employed and you're employed in one of these sectors, you're doing really well. If you're one of the 15 million so people that aren't employed, well, you're in trouble right now. We're looking for an extension. As I said last week, or maybe it wasn't last week's show, it was during the LinkedIn or the Facebook show that I do. Those particular sectors in the marketplace are they're what's happening is in places like Zoom, which is a company, but if you're not in those particular companies, what's happening is you're having trouble maintaining a job or getting a job. So the extension on your inability to pay either your mortgage or your rent has been extended to January 31st. Now, we understand that the Biden administration is probably looking for at least another 6 months, if not 12 months, for those people. They're trying to push this out until the economy is back on its feet so those people can actually catch back up with their payments. Now, is that going to happen? We are seeing some pushback from Munchin in the current Treasury Secretary, in that the funds available to the new administration coming in have been what they call clawback. I hate the term, but it means that they are returning the monies that was available in certain programs by the Treasury back to the Fed. They're recalling the Fed money that is out there to help these struggling people back. Now, is that a good thing for the economy? Politics plays a lot in this. So if you're in those categories of people who need help, who don't have a job, who might necessarily benefit from monies that aren't now available, yeah, that's a political issue there. And we're not sure whether that is going to be something that is going to go forward in the next 50 days or so, or 45 days. How many days left in this current administration there, Daryl?
Well, it'll be through the end of the year, which is what, 20 days?
January 20th, right? Isn't that when the new swearing in? So it's
after the beginning.
So it's 40 days, 45 days, anyway.
Yeah.
Okay. The economy itself, listening to and what we do is we go to Housing Wire and we go to Mortgage News Daily, a couple of websites for real estate and mortgages, try to get a feel on what's happening. Some of them play a larger role in that they interview big CEOs from major companies. In other sites that we go to, it's more nuts and bolts, what's going on with a particular subset of the market, or how are rates affected that day. Both of those things are important because you have to know what's coming as well as what's happening in order to make the best decision about whether you're going to go for that property or that refi or not. So Mortgage News Daily is more in the what's going on right now. And that's a great site for, like, I get my daily rates there. I get articles about what's pushing rates. Like, is it the bond market, or is it COVID, or is it the economy, or is it some national disaster, or is it some natural disaster, or is it a foreign country imploding? Is it some global geopolitical event which is driving the markets? In Housing Wire, we get a broader sense of what's going on. And in the broader sense, they're quoting Charlie Scharf, who is the CEO over at Wells Fargo. He says U.S. economy will rebound quickly after vaccine is distributed. And I agree with that 100%. I think there is, in what has been called in a couple of these articles, pent-up demand. And I think for those people who are looking, who have now an extension through January 31st, who may get another 6-month extension from the Biden administration, moratorium they call it, on paying your mortgage or paying your rent. In second quarter of this year, we're going to see a tipping point. How many people, how many millions of people have already received the vaccine? Now, once this vaccine is taken by people, they're going to feel, and it's probably not the best, but they're going to feel like, okay, I'm free from jail. I can go out, I can enjoy myself. Now whether that's true or not, I'm not sure, but that's what's going to happen. And this pent-up demand for people to go out and spend money. I want to eat out, I want to shop out, I want to travel. All of these things involve spending money. A lot of people who are working haven't really been spending money. I know Amazon stock is up, but there's only so much Amazon crap you can buy and fill up your house before you're just sick of doing that. You really want to get out and experience things. Part of that is this pent-up demand. That pent-up demand in the second quarter, in my opinion, whether it's a good thing or not, because the vaccine is being implemented and distributed, and because the vast majority of people will be getting it through the second and third quarter, you're going to see people getting back to work, whether it's restaurants or whether it's other service-related areas, the airlines. All of these industries are going to come back, and they're going to come back strong, and that's going to help both the people who are in the moratorium for mortgages and rentals, as well as, you know, just general business in business in general. That's what I'm trying to say. And I think that's a good thing. I think this will happen. And I think a lot of people who being COVID wary and being like lectured at wary are really going to be, exploiting their ability to get back out, especially once you've had your COVID shot. Now, Do we get 70% of people out there? Eventually, I think they will. Eventually, what's going to happen is businesses who employ people in the building are going to want to know that you're vaccinated so that there is no liability. There is a toss back and forth whether companies are going to be liable for COVID related sicknesses, and we're not quite sure whether the federal government, Congress is going to step in and fix that. But if it's not, companies are going to require it. So that's why I think by the end of the second, third quarter, we're going to be really roaring in terms of pent-up demand, and that's really going to help people who are in the moratorium right now. Anyway, I'm Jeff Barton, your voice in the mortgage industry. Thanks for tuning in. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in. Thanks very much for listening each and every week. We're on 8 different podcasts, the Big 8, they call them. We're also on YouTube. If you go to YouTube, you want to see the show. We shoot this for video. Jeff Barton, the Mortgage Voice, that's the name of the show there. And we're on 5 radio stations from Albuquerque up to Las Vegas, up in the Tahoe area, as well as the Inland Empire in Southern California. We bring to the show a lot of new guests all the time. And we try to give you options. This is a very strange market where we've seen the real estate market be as hot as it's been. The mortgage market as busy as I've ever seen it in 25 years in the business. And yet we still have 15 million people out of work, and COVID is killing a lot of businesses out there in the street. So if you're looking for options, I think we can provide some today. With us for the first time on the show, and I'm happy, from Limba One Capital, is the regional sales manager, Rob Parsley. And he's going to tell us a little bit about what they do over there. Rob, how are you?
I'm good. Thank you, Jeff.
Excellent. Okay. So you do a lot of multifamily, I see here. And tell us a little bit about what you're doing, some of the criteria by which you lend on, and what your product mix might be.
Sure. Limba One Capital, we really work mostly with real estate investors, right? So it's all non-occupied properties. We basically have 4 different products. We lend on the short-term bridge loan, which is a fix and flip product. We have some rental programs. There's a long-term rental program, a portfolio program, and also the multifamilies you mentioned earlier.
Okay, on the portfolio program, what is it that you lend on? Is it just multifamily, or is it all other kinds of properties as well?
Yeah, so we can do in the portfolio, especially in our premier product, we can do up to 8 units in that program, but it's really designed for single family 1 to 4. We can do as many units as you want. I think the loan amount caps out at $10 million. Okay.
On a program like this, whereby you're keeping the product or you're selling it to one of your private investors, this is not a Fannie Mae, Freddie Mac product, obviously. What is your criteria to lend? What do you look for in your underwriting standards to be able to get people across the finish line and get their loan?
Great question. So we lend strictly to entities, right? We don't lend to individuals. And typically what we're looking for in the rental product or a long-term loan is we're looking at debt service ratio, how well the property is on its own, as well as loan to value, and then ultimately a FICO score too. We do have a minimum FICO score in that program of 660. There's some credit or some rate enhancements at 700 credit score and above.
Okay, now, and what limit do you go up to? What's the dollar amount you do?
I believe we go up to $10 million in that program.
Okay, and do you lend all over the country?
We do. We lend all over the U.S. today. We are not in North Dakota, South Dakota, Vermont, and Nevada at the moment. We are about to be licensed in Nevada.
Yeah, I'm out there. Nevada's I guess a lot of states have their idiosyncrasies, as we're seeing in the current political climate. It looks like every state runs their own state like a different country. And it's that way in the mortgage industry. I know some states have some different ways that they look at lending. When you decide on, obviously, if you're lending in Nevada, it's going to be a little different than you're lending in California or you're lending in other ways, especially with this type of borrower. What are some of the background issues you look at for the borrower? Is it strictly credit history and the ability to repay, or are there some other things that you might consider for different types of borrowers?
Another good question. Yes, we lend outside of the traditional consumer lending space, right? So we're not part of the NMLS, right? We're a commercial lender, just so to speak.
Yep.
So we're really more or less concerned about how well the property is going to perform. So if it's a short-term bridge loan, we're looking at, is the end borrower sponsor getting the property at a decent price? Do they have their budget in mind? And will the after repair value be there so they can make a profit? At the end of the day, we're here to help people invest in real estate and be successful. So those are the things that we're really looking for when you talk about lending to individuals in the space. Nevada specifically, it's not any different than any other state. It's just that they make the barrier of entry pretty high there. You have
Right.
to have a mortgage to be located or to be lending in Nevada. So basically, you have to be located in the state. And
Right.
previous to recently, we didn't have a representative from even one in Nevada, and today we do.
Okay, yeah, no, that's true. And I have an office out there as well. Our company, we're in not as many states as you, but enough to know that, yeah, some states require you have an office there and you have an office manager and, you're basically brick and mortar within the city. Well, not the city, but the state. But essentially, Clark County is the state. I mean, if you go there, I mean, it's a great opportunity out there. Are you seeing opportunities that people are picking up properties and flipping them in Vegas more so than other areas? I know I have a lot of flipper clients out there that do that.
Well, we haven't been there, right? So we can't lend there. So
Oh, I see. Right.
to Nevada, but I do know from everybody I've talked to that it's a very hot market.
It is a very hot market. Yeah. On these bridge loans, what are the terms on the bridge loans? Do you do it for a year, 18 months? And when you're looking to, pay out the bridge loan, do you do it in inspections, or how do you disperse the money?
Great question. So Lima One, this is the product that we founded our company on. We've been doing it for about 10 years. And I think we're one of the absolute best at doing it, to be honest with you. The product is set up as a 13-month loan. Most companies will do a 12-month period. We do 13,
Right.
we do 6 months in there for free. It's kind of an inside joke. But you can do it in 19-month increments, or you can also go out to 24. In California, some markets where it's hard to get permits, it's hard to get started with the construction.
Yep.
That makes a lot of sense, right? And
Yep.
to be able to do that up front without charging the borrower massive extension fees. If you got a guy in San Francisco or Los Angeles that's up against maturity on their loan, most companies are going to ask for a half point to
Yep.
total balance to extend for 6 months. We kind of try to get ahead of that up front and put together some really great programs for that.
So your knowledge, obviously, of the different areas you lend in is important, right? I mean, you mentioned Los Angeles. Yes, it's one of the crazy things about trying to improve the housing market out here is that if you need more you need more housing, you shouldn't prevent people from building, but that's what they do. All these towns and municipalities have their hand in your pocket, and it does delay the closing. So for you to have the local knowledge to be able to either extend or get to it early, that's a good thing.
Yeah, it's a great thing, and we recently rolled out a new construction program too that's been hot on the West Coast. You talk about housing shortages. We work really well with builders and small developers. It was one of the first products that came back to the market when we paused with COVID. We just sort of stopped and took a look at what we're doing. Wanted to make sure we're going to be in tune with the market when it came back. And I'm proud to say that we even came back roaring like a lion. We came back with all of our products, and today we're right back where we were pre-COVID, and the programs are stronger than ever.
Okay, cost. Let's talk a little bit about that. Give me a range of prices that you're going to get, and what do you got to do to get the best price?
Sure. It's really easy in the fix and flip or even in the new construction program, right? So it's all based on experience. And
okay.
If you're a brand new investor getting into the market, we'll help you, right? We're not scared to take on the new fix and flip customer.
Right.
They're going to pay a little bit more than an experienced customer would, right? So we have to cater to the end user and guys that are doing 24 plus flips a year. They're looking for the best rate and fee structure, and I think we have it today. But we work with both ends of the spectrum.
Can you give us an idea of what that might be for the people listening who are looking to see whether what the cost might be, or is that just too?
Sure. So
right.
For a brand new person, never done a flip before, you can expect to pay an origination fee of about 2.25%, and your interest rate is going to be below 10.
Okay.
It's only for 13 months.
Okay.
My seasoned guys, they're going to pay about 1%, and they're going to be sitting right around 7% for 13 months, interest only.
Okay, excellent. Obviously, having the experience in your company to help new people, anybody that's in any business is going to know, look, if you're going to go to college, it's going to cost you money, right? So that's a really important thing to know, that you're able to help both new people and obviously give the best rates to people who have been in the business a long time.
Right, and it's a great structure. I'll tell you a little about it. So as they get more flips under their belt, their pricing gets better. So
right.
Encourage people to come back, and even the mortgage business is a long time, right? If you've
Yep.
done business with somebody before and you get to understand their financial picture, not only can you help them, but they're much easier to work with, right? So if
Absolutely.
they come back, make sure that we're improving not only our process for them, but also they're getting a better price when they come back.
Hey, Rob, we're up against the clock. You want to shout out a way by which somebody can get a hold of you if they're listening to the show and want to get into this business?
Yeah, that'd be great. My name is Rob Parsley. I'm the Region Sales Manager of the Western Division for Lima One Capital. And you can email me at rparsley@lima1.com. That can also be reached on my cell phone at 619-651-5187.
Rob, thanks very much for coming on. Really enjoyed it. Like to have you back soon, maybe by the first of the year, to see what 2021 looks like.
Great. Hey, thanks, Jeff. I appreciate it.
Yeah, thank you very much. That's Rob Parsley from Lima One Capital, and I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in and listening to the show. We really appreciate it. And obviously, if you want to hear the show and more of it, if you go to either YouTube, Jeff Barton, the Mortgage Voice, or you hear us on 8 major podcasts, the Big 8 they call them, or on 5 radio stations in 3 different states, say that you like the show. It really helps us. There are a lot of people that just don't know our industry the way I know it and the way the guests know it. So if you want more of this information, yes, that's my plug, and I'll stop there. Okay. Next guest on the show, a guy I've known for many years, excellent, smart, bright guy who has been in the industry both on real estate and mortgage loans, but just a general knowledge of what's going on in the industry. A guy named Freddie Ojeda, worked for Malibu Funding. Freddie, how are you?
I'm very good, Jeff. How are you?
I'm fine, thank you, and thanks very much for coming on. I do appreciate it. I have a couple of questions for you. I know you're down in the San Diego, California area, Temecula. Tell me, how is real estate and what's happening down there in the mortgage market?
Well, right now, as far as real estate, there is not enough inventory like anywhere else because of the interest rates that are so low. That triggered a lot of created an increase in prices like crazy. I mean, once a listing comes up available, there is a lot of multiple offers, out there in the price. So it's there's not enough inventory. But again, a lot of people are taking advantage on the historic low interest rates. I mean, everybody wants to refinance and then, lower their payments and buy new homes as well, because if before they could afford for the same payment a house of let's say $500,000, now with this low crazy interest rates they can afford a house for probably $600,000. So that created a demand and increase of prices as well.
That's interesting, and also that's exactly what's happening, and that's why they keep saying that there's millions of people who can take advantage of these low interest rates who still have not done it. Do you see the fact that there's so many refis interfering with the ability of people to get purchase loans, or do you think there's enough capacity within the system to be able to handle both? I know that purchase loans usually take precedent, but I also know that the entire industry has slowed down quite a bit. So if you're in a 30-day contract, could be a problem.
Yeah, absolutely. Nowadays, if you are buying a house, it would be pretty safe to make a 45-day escrow at least.
Yeah,
of
Yeah.
the demand. I mean, all the riders are busy, and it's a lot of demand for these loans. So a longer escrow.
Do you see the employment situation improving a lot when we have the vaccine more readily available for people, let's say in May and June?
Well, once I believe that once they start vaccinating people, of course, that's gonna create more confidence on borrowers and potential new homeowners. As far as the forbearance that we will have right now, the moratorium. Remember that's going to expire at the end of the year, so we don't know what situation.
Yeah, they've just extended that moratorium, Freddie. They extended it out till January 31st.
Sorry?
I said the moratorium has been extended to January 31st.
Okay. All right. Yeah. January 31st. Okay, that's cool. And they also increased the amount for the non-conforming loans.
Right.
That increased pretty much. I mean, for San Diego County, it used to be 701,500. Now it's going to be 753,000. So that's like $50,000 more. That's good. That's for conforming punishment.
Yeah, the conforming loan limits, right. When you get one of these clients that wants to buy a house and they're obviously in competition, how do you make sure that they have the best advantage when they present their offer?
I'm sorry, couldn't hear you that.
No problem. When you're representing a buyer and you want to get a house, what do you tell them to make sure that their offer is the best offer? I mean, rather than, do you limit the contingencies? Do you have a pre-approval letter? What do you do?
Well, right now pre-approval letters are kind of outdated. They
Yep.
they want fully desktop underwriting.
Yep, they do. Yep.
The stronger their offer is, the better chances you have to be accepted. And of course, get rid of the contingencies as much as you can.
No, I agree. I think that's right. Do you see that there's frustration in the marketplace, or are buyers actually okay with that? I mean, how are you dealing with that kind of insecurity, especially from a buyer who's a first-time millennial and they don't know what's going on in the market?
Yeah, I mean, most of the frustration from borrowers, from first-time buyers especially, I'm noticing that it's because of not enough inventory, not enough houses to
Yep.
choose. So they're pretty much stuck with whatever new listings come out on the market. But I mean, these historic low rates, that's a motivation instead of gotta turn the frustration into a motivation for the borrowers, because with these low interest rates, I mean, they can pretty much afford a higher price house.
Okay, when we're talking rates here, are most of your borrowers Ginnie Mae, Fannie Mae, Freddie Mac borrowers, or are they non-QM borrowers?
Well, some of them are. I mean, but some of them are investors also. I mean, or they have a good chunk of a down payment.
Do you find that the people who don't fit into the Fannie Freddie box, are they more apt to accept a higher rate, or are they still extremely rate conscious? I know some of these borrowers who know that they aren't necessarily pristine will understand that they're going to pay more. Do you see that your borrowers are like that too?
Yeah, I mean, most of my buyers, as long as they can get the loan to buy their dream house or their first house, I mean, they're not too much concerned of the interest rate. I mean, they shouldn't, because interest rate is just a number. Should be more concerned about how much is going to be the total payment and what are they getting for their dollars. See what I'm saying?
Oh, absolutely. And I think concentrating on what you can afford on a monthly basis is the basis by which you're going to go out there and make decisions on buying a house. No question.
Yeah, absolutely. And remember also that San Diego is a military town, so a lot of
VA.
loans are for military, veterans loans. So,
Yeah.
that's a huge part of the market right here in San Diego, the military.
Right, and I think by nature of being a military town, the VA loan itself, and it's 100% financing, but are you finding difficulty to have veterans coming up with the funding fee, or is that not a problem? Prices are so high.
It's not a problem. Shouldn't be a problem. That's not a problem. I mean, everybody wants to live in San Diego. It's beautiful. Famous city in America, Jeff.
Hey, I love San Diego. Are you kidding me? I have big branch of my family lives down there. I love it down there.
Yeah, it's a beautiful city, for sure.
So what do you got for weather down there today? About 75 and sunny at the beach?
Yeah, probably, yeah. Approximately that temperature, it's beautiful. Weather right here is awesome.
Hey, Freddie, I really appreciate you coming on the show. It's really a pleasure once again to talk to you, and I'm glad we reconnected. You want to shout out your phone number, way people can get in touch with you if they need a terrific agent down there in the San Diego area?
Sure, thank you, Jeff. Same here. My phone number is 619-201-6689. Again, 619-201-6689.
Okay, thank you very much. Thanks, Freddie, for coming on the show.
Thank you. Bye-bye.
Okay, and that's Freddie Ojeda, and he's a terrific real estate loan officer guy down there in San Diego. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in each and every week. Thanks very much for listening. We have some information that is valuable, and if it isn't, just listen a little bit longer, and you'll be able to find something in the show. We have 3 guests on each week. We're on Saturday and Sunday, a bunch of different areas from Albuquerque up to Las Vegas, Nevada, in the Inland Empire, and certainly up in the Lake Tahoe area. 8 major podcasts, as well as YouTube, Jeff Barton, The Mortgage Voice. That's the channel. Go there. Hundreds of shows there, and certainly the topical nature of what we talk about, you can see each and every day. We do a LinkedIn and a Facebook, as well as Twitter and Instagram shows. Yes, you've got to be everywhere if you're in this business right now, and hopefully we can help you solve some of the problems that you're going to have trying to get a loan, especially if it's not the type of loan where they're going to be selling it to Fannie Mae, Freddie Mac, the cookie cutter type loan. Obviously, we do those too, but we have answers for all different kinds of products out there. In regards to some of that is Paul Vincent, who works over at Accelerate Capital. He's the national account executive for them, and he joins us now. Paul, how are you?
Thank you. Thanks for having me.
You're welcome. Thank you very much. Okay. Explain to us, Accelerate, what's some of the important programs that you're offering and some of the niches that you might be able to help some borrowers with.
Absolutely. Thank you.
Sure.
We specialize in what's typically called in our industry non-QM loans, and what that really means is it's a non-traditional type of financing intended for borrowers who typically are not going to be able to provide 2 years tax returns and pay stubs in order to qualify. So, for example, and this tends to really lean towards self-employed borrowers, borrowers who are independent contractors, things like that.
Right.
So, for example, go ahead.
No, I'm agreeing with you, and sort of like a muse would be in the ancient Greek world.
So for example, somebody could purchase a home or refinance their home using just their bank statement. So if you can provide either 24 months, 12 months, or most recently, 2-month bank statements to show your cash flow and a profit and loss statement that supports that, you can qualify. And we can do that up to 90% loan to value. So it's 10% down, and your business or personal bank statements to show us your cash flow, and you can be approved.
That's interesting. Can I ask you a quick question on that 2-month bank statements? If you're doing 2 months, that must mean you have a strong appetite for these loans from your investors, and that bodes well for coming out of the COVID recession here, right?
Absolutely.
Right.
because again, we understand that over the course of the last few months, cash flow for some businesses has declined. However, if we can be satisfied in the last 2 to 3 months, your business has resumed, and that we can see that there's cash flow that will support the payment that you need, we can go ahead and approve you.
That's good news. I think that means that the people at your company were risk averse, but at the same time looking at the market overall, saying, "Hey, look, if you're out of it now, and also future, obviously, by June, July, we're going to be really out of this thing, probably humming." And yeah, I think so. What are some of the other programs you might be able to offer?
Okay. Another program that's very popular, and this would be for borrowers who are not self-employed, and that would be, it's called a VOE only. So if somebody can provide a verification of employment, not for a family-owned business, but for a normal employee,
right,
you qualify with just a VOE only. If you've worked at your job for 2 years minimum, we can take the VOE and qualify you with just that.
Now, what's the difference between a VOE program and the old stated programs?
A VOE program actually is your human resources or whomever is in charge of payroll is going to fill out a verification of employment. So it does have to, be supported by somebody in your company.
Okay, good.
So we are verifying income, but we're verifying it with just the VOE. So for somebody who maybe doesn't have their tax returns done or something of that nature, can't provide us with full pay stubs and tax returns, we can just use a VOE. Whereas the stated income program, actually, we're not looking for any supporting documentation at all.
Okay, and do you do stated? I just said that offhand. I have no idea. Do you?
That's our last niche.
Uh-huh.
Be strictly for investment properties. Our investor program requires no income documentation whatsoever. We base it strictly on the ability of the property to debt service itself. So in other words, if the rent's coming in, or at least 75% of your TITI is the payment, interest, taxes, and insurance, we can lend strictly based on that as long as you have decent credit. Then again, you can purchase up to with 20% down. You can buy an investment property, no income documentation, no tax returns, nothing of that nature. We're strictly looking at the ability of the property to debt service itself.
I love that program, and I know that there's a strong appetite for something like that. Do you see that particular market booming? Has it slowed down? I mean, where are you?
In fact, since we brought it back, my phone's ringing off the hook.
Mm-hmm.
And interestingly enough, what we've discovered, what our company discovered, is that these types of loans actually perform extremely well.
Right.
There was some concern back in March when things began to change, that perhaps these loans might be problematic. Investors would stop making payments and so forth, but in fact, quite the opposite. These types of loans have performed almost better than our full doc loans.
Yeah, that's interesting, right? I mean, we've seen numbers come down, obviously, for anything in forbearance, but in terms of the excessive forbearance, those that have been in forbearance for 6 months or longer, yes, these particular programs, which you would think are attracting a different kind of borrower, actually perform better. I looked at the research too. It's very interesting. Yeah.
Yes, these tend to be people with good credit,
right,
equity in the property, and just look. And so essentially, yes, if somebody can provide, has a property and it's going to cash flow to a reasonable extent, as I said, 75%. It doesn't even have to be on a one-to-one basis. So.
Right.
Just if the rent was $750 and your PITI was $1,000, we're good.
Yeah, no, that's excellent. Tell me where your pricing begins and what kind of costs there are associated with a loan like this.
Okay, so the our only cost as a borrower, our underwriting fee is $1,195,
Okay.
and then rates on these programs can be as low as 3.875, and then up to the mid sixes.
I see, and that depends on you, the amount of money down, stuff like that.
Depending on the loan to value,
Okay.
the FICO score, et cetera.
Okay, so in your program, then it's not only debt service, but you're also looking at some skin in the game as well as good credit standing to get the best pricing, the best rate.
Precisely. And
Okay.
I left something out that in many cases somebody can provide tax returns, but maybe not 2 years tax returns. But we can work with just 1 year tax return, which is also available.
No, that's excellent. I love the product mix that you have. You say business is booming. Are you seeing it locally or nationally the same way that everywhere people are looking for this type of loan or your type of products?
Booming. I get calls from a number of states, and particularly in the southwestern states, we're getting a lot of attention. Again, back in March, a lot of my competitors
Right.
went away, or these programs were shelved for a little bit.
Right.
Now that they're back, there's definitely an appetite for them.
Hey, Paul, thanks very much. We're up against the clock right now. I really appreciate you coming on. Could you shout out your telephone number or a way by which people can get in touch with you?
Absolutely. My number is 714-606-8592. You call or text me.
Okay. Thanks very much for coming on the show. I want to do it again. That was a lot of information, a lot of things to ponder for people out there. Thanks a lot.
Thank you so much. Appreciate you having me on.
Thank you. That's Paul Vincent. He's the Senior National Account Executive for Accelerate Capital. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Hi, I'm Jeff Barton, your voice in the mortgage industry. Thanks for tuning in and listening to the show this week as well as every other week. Lots to get to, but quick maintenance. You can see us on YouTube. You can hear us on 5 stations. We're in 3 different states, from Albuquerque to Vegas, up to Lake Tahoe and in the Inland Empire. And we're on 8 major podcasts. You can see us, hear us, find me anywhere. I had a client the other day who said, I couldn't get a hold of you. And I'm thinking, if you can't get a hold of me, you can't get a hold of anybody, because not only is my cell phone listed everywhere, but the emails, the social media, the places where I'm accessible are pretty much everywhere. I have a blog, bartonblog.com. You can get me. So if you're out there and you need a question answered or you need some advice, anything, please call, listen to the show. When you do listen to the show, tell us how you like it. Click on whether you want to see more or hear more or anything that will help our show get to more people. There's information here that is important to you, but it's also important to the broader person who's looking for a mortgage, looking for the best rate, looking for a program. Today, we're going to have a couple of great people on the show, or have had great people on the show in the past who can tell you about programs, about different ways by which, if you don't fit into cookie cutter mold, you can get a loan. If you do fit into cookie cutter loan, what's the best rate? How do I best approach this entire process? If you go to malibufunding.net, that's the company that sponsors the show, you can see that there are 40, 50 different loan officers there. Choose one, ask a question. We just went through a scenario with a friend of mine that I have a great couple loan officers that I constantly ask to help me with my own pricing. Why? Because they're better at it than me. And that's part of the reason that we do this show, is that, look, if I can't do it, we're going to try to help you find somebody that can do it. And that's really important. This person had a condo-tel or a condo hotel, meaning that you go to a resort area, you buy a condo, but the resort management rents it out when you're not there. That's a condo hotel. Are there companies lending on property like that? If you go up to Lake Tahoe, if you go to a lot of different resort areas, especially in the wintertime with skiing and in the summertime with beach access to places. If you can find some lender that can do this, we did find one. It's a non-QM product. Prices started about 5.75, but because you're going to be paying more in rate, you're going to make up for it in the amount of money that you can rent the condo for. Anyway, we were able to help my friend and one of my loan officers, Luke Mankey, great guy, been on the show many times, talk about problem solving, and he was able to do that. Housing Wire, as I said earlier, we go to Housing Wire a lot for some of the information. They have great videos as well. Now, listening to mortgage or economic videos, unless you're a geek, is really boring. So I'll try to synopsisize, if that's even a word, what she was trying to say. Selma Hepp is the chief economic officer for CoreLogic. She was at Compass, Trujillo, CAR, NAR, that's California Association of Realtors, or National Association of Realtors. So this is a person who's been around a long time, and she was on a show hosted by Sarah Wheeler on Housing Wire. It's good, and she's good because she brings on heavyweights, and Housing Wire has a name so that they can get these kind of people on the show, which is great because I like to hear from them. She said, and this is of course Selma Hepp, she said she's not worried about price increases in real estate. She's comparing this particular real estate price increase and the rise last year about 7% in some markets, 5 to 7% across the country. So that's a lot in terms of a pandemic having real estate prices. And what she said was, hey, this is not something to worry about because it's not like 2008. We do not have bad loans out there. We do not have loans where we are inflating the asset, i.e. the property, in order to secure the loan. We do not have appraisals which are just trying to keep business like the bond market was trying to keep business the last go around when they were securitizing GSE bonds or private market capitalization of the GSEs with the bonds that weren't secured by good loans. This is not the case right now. Right now we have great loans, and therefore the rise in housing prices are due to the fact, and this was interesting, and I thought this was the major point. We play a chess game with who's to blame or what causes what. The reality here is in the last 20 years, we've only been building 1 million houses a year. 20 million houses in 20 years. The population growth is 50 million. So you can see right there that there's more people that need houses than were houses built. So this is a 20-year trend. This isn't something that just happened or something that can be fixed, more importantly. So therefore, the rise in house prices has to do with supply and demand. Simply put, there are not enough houses. Now, how do we solve this? There's a number of ways that governments can help, and there's a number of ways that they can't help. Ways they can help: making it easier to build homes. The problem is most homes are built, most developments are built with permitting through a municipality. It's not a state issue, it's not a national issue. It's your town, what is your town allowing in, your area? Now, in great swaths of the country, I love that word, swaths, you have vast tracts of land. Now, in Los Angeles, in outside of Denver, in Salt Lake, in great areas of Texas, there are huge areas where large-scale development is possible. But most municipalities and the exactions they make on builders to be able to do that kind of building is prohibitive to building those kind of developments because it's just too expensive. An exaction would be, okay, you want to build 500 homes, 5,000 homes, you've got to put in all the streets, all the sewers, all the water main connections, plus we want to have a holdback on the amount of money that you sell that property for until you sell 90%. So a builder is on the hook for it. Now, most of these projects in large scale take 10 years, maybe more, to get through the system. How government can help is by bypassing some of the processes by which they get permits. There are cookie cutter ways by which things have been done that they can be done on multiple projects. If geology, if soils, if archaeology, if there are, and if you don't know, there are many, many things that stand between us and the amount of housing we need. Now, what governments can't do is they can't be a NIMBY, not in my backyard, right? A lot of smaller communities, based on the demographic of the communities, do not want to see an influx of different levels of income into their community. Now, that's all, I guess, confusing speak. What it means is we don't want our communities to limit who comes in. If you're in a certain type of community, you don't want certain people in there. They prevent by making sure that it's very costly, so low-income people can't get in there. And low-income people in this particular, when we're talking about COVID, happens to be African Americans, Latinos, and other ethnic groups that have lost their jobs because of the inequity with what they're either getting paid or the amount of people that are affected either by restaurant layoffs or by large-scale like venues being closed because you can't have, football stadiums, the soccer stadiums, theaters. You name the amount of people that work at those places that house large-scale people that come in there to watch the show or to see a sporting event. Now, what happens in situations where a town puts up barriers to not allow low-income people in is that you're obviously not allowing more housing to be built. And that's the only way it can be built. Either you allow low-income people by subsidizing either the purchase of the land or the house themselves, or bypassing the permitting process that is erected to stop low-income housing. Or on large scale, you stop the exaction process to let these people make money. Now, because we've had not enough housing being built over the last 20 years, the millennial population, who is now getting into the major home buying, they are the largest home buying people in America, the largest group. Let me see how many people it is. Oh, okay, it's 50 million people 28 to 30 years old. Is that right? That can't be right. Is that right, Daryl? 50 million people from 28 to 30? I think it's 20 to 30. It's got to be that, or 20 to 38. It sounds like a lot of people. Anyway, they're the ones who are out there right now wanting to build homes, and they just don't. I'm not build homes, but buy homes. There's just not enough homes out there. So if the cities want to help, if government wants to help, that's what they can do. But the reality is, it's too many people, not enough housing, and this is how it's going to be. Which is why they say the price is going up. It's probably sustainable and probably going to get worse. So if you're out there buying a house, buy one now. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for listening to the show. We'll see you next week.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.